Now, inflation might not be the kind of thing that most of us lose sleep over, but inflation is here right now, it's real, and it acts like a silent tax. So as investors, it's something we should pay attention to. Now, Treasury Secretary Janet Yellen says that the US is not losing control over inflation. It's going to be transitory. However, for more than a year now, you and I have been able to see the effect of inflation around us in rising prices. So we know it's real. And that's what I want to talk about today. Now, the classic definition of inflation is just too many dollars chasing too few goods. It forces, bids up the price of those goods as people vie to get the limited supply of goods. Now, the government's certainly been printing the too much money part. Even though they do it electronically, it's still creating more money. But the government's been printing this kind of money, big dollar amounts for 20 years or more, without affecting inflation dramatically. So what gives here? What's different is that we've had these major deflationary forces for the last couple of decades. The internet has been cutting out one middleman after another, lowering prices for all of us. This offsets inflation that would be normally created in other areas. China and other low-cost producers are flooding the markets with low-cost goods. Again, we've got too many goods chasing too few dollars. Now, even though the dollars were there because the government printed them, they weren't being spent. The savings rates have gone up. So the dollars, we had too many goods chasing too few dollars, in effect. And this is the opposite of inflation. It's called deflation, and some people call it disinflation. So these inflationary or deflationary factors in the last 20 or 30 years have started to go into reverse for one of the first times. And now our supply chains are being interrupted, shrinking the supplies of goods. It's sort of exacerbating this shortage of goods during with a surplus of money, adding to inflationary pressures. Now, there's a thing called just-in-time inventories that companies have adopted over the last 20 or 30 years, which gives companies very precise cost controls over their inventories. So it's good for their earnings, but it's turned out that it's very fragile. One link in the supply chain being disrupted interrupts the whole chain, and we're seeing that now. COVID shut down factories in China last year. Their brutal lockdowns meant there were no workers, and you have to have workers to run these factories. Over on this side of the pond, we had COVID shutting down sawmills in the northwest part of the country. And when they tried to open them back up earlier this year, their labor forces had moved on. So we had this huge shortage of lumber, just as we had great demand for construction materials, drove the price of lumber way up, and housing prices have sort of followed. There was a fire last year in a computer chip factory in Taiwan that's rippled through the computer chip industry, showing the fragility in that part of the supply chain. Matter of fact, Apple just announced that they don't have enough computer chips to make iPhones and iPads, so they're cutting back on iPad production. So this is affecting a lot of industries. The net result is fewer goods are being available just as the government's flooding the economy with all this extra money. So we have too much money chasing too few goods, pricing inflation up. In fact, it's the highest in 30 years. Last week, inflation, year over year inflation was 6.2%. So it just keeps inching up. Every month it goes a little bit higher. When will supply chains recover to start increasing the supply and maybe take some pressure off inflation? I've seen reports that computer chip supplies won't stabilize until the end of next year at the earliest, maybe 2024 at the latest. So we have roughly a year of price pressure there. Plus the world is in an energy crisis. We can see that every day as we go by gas stations and we see the price of gasoline going up, up, up. Whole nations have moved away from fossil fuels to green energy, and they've done so before the replacement green energy was in place. Pipelines are being shut down, drilling leases are being canceled, and all of these things are restricting the supply of energy. Just as economies are gearing up after the COVID crash last year, and they need more energy to run the factories and that type of thing. So most of these are turning out to be foolish policy decisions by politicians who don't understand economics, but want to have green credentials they can tout to their voters. This is happening not just in the US, but everywhere. Australia has been for years the main provider of coal to China. And about half of China's energy came from coal-fired power plants. Now, China recently stopped buying coal from Australia for purely political reasons. Australia made some noises about backing the people in Hong Kong, and China says we can't have that. So this was all political, but China had no replacement source of energy, and now they're having to ration diesel. Factories are shutting down 1 to 2 days a week. So again, we have less supply just because they don't have enough energy to run the factories. Now, China, if you think about this, is sort of at the head of the US supply chain. And if they're rationing energy in China, effectively the US supply chain is having energy rationed. And we have not yet seen the worst of the supply chain disruptions, because this has to trickle back down. Now, if you think about the fact that the normalization of the US supply chain problems is in China's hands, to me, that's concerning, because right now we've got this economic tug of war going on between the US and China. And interrupted supply chains mean lower productivity, and it means a stagnating economy. That's what Ryan was talking about, and prices have been going up in stocks, but the earnings haven't gone up commensurately. So compared to the earnings, stock prices are getting more and more expensive. Eventually, that's going to top out someplace. We haven't seen signs of that yet, so we're not going to get out to actually see it manifested in the pricing. But that's one of the things that we've got our ear to the ground for. Now, history shows us the two most common reasons for economic recessions are rising interest rates and rising energy prices. Both take money out of the hands of consumers, and consumer spending makes up about 60% of our economy. So this is a real drag on the economy when interest rates, or in this case, energy prices are going up. Amazon reported last week that their retail side of their business lost money in the third quarter because of shortages in both labor and consumer goods. Apple warns that shortages are going to adversely affect profits. They're not going to be able to sell as many iPads. And advertising is being cut back due to retailer uncertainty about supplies of goods. Ryan mentioned this with Facebook and some other companies that rely on this ad money. All of this points to a slowing economy, and we've got our eye on that real closely.